Hey everyone, hopefully having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions. It's generally related to three different topics: wealth building, commodities, and/or financial topics. We're going to dive right in, see what's going on, and what people are sharing. If you want to follow me, it's at @Finance. And if you want to join our community, finding-value.com, where I dive deeper into all these topics, looking for potential investment opportunities, sharing my macro opinion, looking at individual companies, sharing the conference calls, and more information, the technicals and stuff like that, through Q&A sessions on the weekends and midweek updates that I release usually late Tuesday at night. All right, so diving in here, let's see what's going on today. It says buying the next big thing rarely works out. Buying the second best in a specific sector rarely works out. Resisting the FOMO and sticking with the leaders will save you a lot of money. So what he's talking about is ChargePoint, QuantumScape. QuantumScape, I think, was working on a battery. Beyond Meat. Beyond Meat, a lot of people were talking about Beyond Meat back in 2020. I think Kathy Wood was real big on some of these. Open Door Technologies, that was a company that was buying homes and then reselling them and trying to make profit doing that. It looks like they weren't very successful at doing that, obviously, with the down 93.77% over the past 5 years. So how can an investor avoid these types of companies? One thing that is something to look for, just an FYI, is look for companies that make money. If they don't make any money and they're losing money and they consistently lose money, be very careful with those companies. You're going to have to look in further into the company, see where potential earnings could be coming from. These companies control the selling price of what they sell. So it's not like they are equivalent to a commodity company. Commodity moves, their earnings move up and down based off of the commodity price. And every single financial metric moves with the commodity price. The return on investment, the return on equity, their price to book, price to earnings, their earnings, everything moves off the price of the commodity itself. Other companies that you are looking at, they may not have these big drawdowns. That might be them going bankrupt. It's like it's not the same thing as I'll say a cyclical commodity price moving up and down, pushing earnings up and down in the companies. So most of these are kind of leading edge technology type companies. Those are the ones that I avoid. You can make a lot of money off them quite quickly. It is possible, but they also have a high I was going to say a high success rate at failing. So it's a high failure rate is what they have. So the companies that Buffett would go after and Peter Lynch are the companies that I prefer to go after. Insurance companies, banks, stuff that's really boring that doesn't change. Then it just becomes a scaling problem. So they've got a good product, MasterCard, Visa, whatever it is, and then they just have to scale it to size. And that's where their growth comes from, is scaling it all up. The tech companies can scale quite quickly because if it's a software company, they can scale software, it's super quick. The problem is the quicker something can scale also means the quicker that they can fail, because someone else, a competitor, can scale just as fast. If it's infrastructure, it's very hard to scale. It basically is a moat, or you're building buildings like to eat at or something like that. It's a little bit more difficult to create those as quickly. Natural gas tightness is coming. So natural gas fundamental tightness will return by mid-June. The bearish injections so far are driven by bearish weather. And something that looks to be transitory as the cooling demand season gets underway. So he's bullish natural gas, and I'm incredibly bullish on natural gas over the next 5 years. It's the wall of LNG takeaway capacity, all of the electricity generation that people are very hyped up on. And natural gas is the swing producer for renewables. So if they put more renewables in, they're going to need more natural gas as a potential backup. So when the sun is hidden beneath clouds, or if the wind isn't blowing, you don't get those pressure differentials from the sun, then we fire up the natural gas power plants. So I'm very bullish on natural gas because of the swing producer of natural gas, the power burn from natural gas, which is increasing, and we've got that LNG takeaway capacity, which will share it throughout the world and bring our Henry Hub pricing up and the TTF gas pricing probably lower and meet somewhere in the middle. Porter Stanbury says, never ever sell a great business. And this is about holding period. And what they're saying is do all the upfront work, find these great businesses that won't get decimated by technology changing. It's the Warren Buffett approach. It's, find a beverage company, a food company, insurance, banking, these companies that basically stand the test of time and provide services or goods to people. So he says, and I'm just going to read what's highlighted. It says, it only dawned on me the last few years that the way I was doing things was quite stupid. My model when I was 40, and even when I was in my early 50s, was that you try to buy a business for half or less than it's worth. And when it gets valued at 90% or more of intrinsic value, it's time to move on. That sounds rational, but it's the dumbest thing. I'm going to read the whole thing, guys. And the reason it's the dumbest thing is we don't know what the intrinsic value really is. We may have a guess at it, but the great business surprise to the upside. And they really kind of blow your mind in terms of what they're actually able to do. Warren Buffett was having difficulty paying $25 million for See's Candies. And basically the dividends that Berkshire Hathaway has received in the last few decades is approaching $3 billion, more than 100 times what they invested. They would never have guessed that in their wildest dreams. It was going to give $2.5 to $3 billion in dividends and counting. We are never able to really appreciate how great some good businesses can be. We definitely will not be able to understand which businesses are the great ones until after we've owned them for a while. So basically, the advice to my 40-year-old self would be, listen, idiot, you're going to get some companies in the portfolio that are truly exceptional. You will know that they are exceptional. It says, you will know that they are exceptional. You will know. When you own an exceptional business, do not sell it at 90% of intrinsic value. Do not sell it when it's fully valued. Do not sell it when it's overpriced. You can possibly think about selling it when it's egregiously overpriced. And when you figure out the difference between overpriced and egregiously overpriced, call me collect. So basically what you want to do is you do all the upfront work. You find a boring business that won't get technology away. In fact, you want to find businesses where technology will benefit, like banking, like insurance, like food companies where you can order ahead through technology and stuff like that. And then you just sit in them and wait. You just buy them and sit forever. That's it. That's the secret. But some people say, oh, well, I'm not going to get rich quick. Well, it depends what your timeline is. Some of these companies go up massively in 10 years. And I think 10 years for a small amount of money to grow into a very large sum is not that long. It really isn't. To do it in a year or two, now you're pushing luck. Now you're pushing the luck button pretty hard. Josh Young says, oil demand is picking up and the market is going to surprise us if we're not investing in it, says the UAE energy minister. Demand's picking up and the supply side's looking pretty rough from the investing standpoint. Bald Guy Money, he says, platinum is certainly turning a corner and we agree on the trajectory. My skepticism is a result of the macro-driven divergence between gold and platinum and its role as an industrial metal. Platinum has substitutes, and with diesel losing favor, especially in Europe, I still think silver will outperform it. Wishing you a great day, Sniper. And this is silver and platinum moving together. It's gold. Gold's already broken out. You can see the divergence there, what he has there in 2016, and platinum's been squeezing sideways. I don't hear any talk about the fundamentals of platinum in this. Platinum's been running deficits. Platinum has been substituting palladium, and we're running pretty big deficits, a little over 1 million ounces a year. That's quite large given it's only a 6 to 8 million ounce market per year. So it depends if you use the production figures, it's more like 6 point something. With recycling, it's 8 million. So if I were to look at the charts and I were to make a non-biased opinion between platinum and, say, silver. So here's platinum divided by silver. If I were to take my non-biased opinion, I'd say this is a falling wedge that's going to break to the upside. So I would say that platinum has a good likelihood to potentially outperform silver when this does break to the upside. That is when we would see that. Last bull market, I think that we are located somewhere around here. This was the bull market in commodities. I think that we're aligned very similarly to that area last time. If you look at, say, like home builders and real estate cycle and all these other things. So I think platinum's going to outperform silver. That's my take. So I'm in the exact opposite camp as Bald Guy Money is in his opinion. Now, I could easily see someone say and make a case for silver that we've got a cup and handle pattern that's ready to break to the upside, and that silver will outperform platinum in the short term first. But that's not what the ratio chart is necessarily telling me. But the ratio chart won't tell us future price movements, and that's where you have to make a judgment call. Some people say, "Well, I want to invest in the best performing precious metal." Well, then you basically cut it down to silver and platinum here, and silver's at a 1 to 100-ish ratio against gold, and platinum's never been this cheap against gold either. So what's going to outperform first or second? No one knows that answer. And that's where you have to be comfortable with. You have to be comfortable with knowing that answer. So if you don't know the answer and they're both incredibly cheap, why don't you invest in both of them? That's what I would do. And that's what I've done. Coming out, we've got Logan. He says, now you all understand this premise. Rates first hit 7% in 2022, resulting in the fourth year of record low sales. However, if rates had not increased, the cooling down of price growth would not have happened. And this is what it says back in 2021. It says, we need higher mortgage rates to cool the housing market. Housing 2021 isn't the housing bubble of 2005. The reason they increased the interest rates as fast as they could in 2021, they jacked those things up quickly. It's to slow bank lending. And that's exactly what they were targeting. They were targeting the housing market to slow it down. Now, they didn't stop the housing market because we still were building a lot of new homes and new home sales went up. And yes, they had to buy down interest rates for them to move product. But interest rates was a big driver in the slowdown of the housing market. 2021, the demand is there, but that demand was held back by affordability. And the bubble of 2005 was the exact opposite case. They gave out free loans, they lowered interest rates, and they were trying to push product out there as quickly as possible. The loans went bust, and then what you're left with is a bunch of foreclosed homes and no buyers because all the buyers were sucked into the market with interest-only crap loans. 2021 is different because you've got a bunch of buyers, but they're not being able to purchase because interest rates are high. That's a completely different market than '05. And I hear a lot of people, oh, we're going to get this big crash in real estate like 2008. No, we're not, because we don't have the bad loans. We don't have all that crap in the system. It's basically admitting that you have no idea what the real estate market is like, at least in residential real estate, versus that time. 2008 was a repeat of the 1920s bust that occurred in the 1930s. And then all of that debt deleveraging that they had in the 1930s caused the Great Depression. So go look at history, go look at the foreclosures, go look at the loans in at least residential real estate. I'm not talking about commercial. In commercial real estate, it's rich people taking losses, not the average Joe. So it's a different setup, in my opinion, and it is something to study in history and get familiar with. Rick Rule says, so true, and this is here, it says, the number goes up no matter which color their tie is to, and this is Democrats versus Republicans. It says, the U.S. debt rises irrespective of who is in the White House. Debt ceiling and gross federal debt in U.S. 1981 to 2023 in trillions of U.S. dollars. It is up, 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 and up. And the debt ceiling continues to get adjusted higher, and the debt continues to move higher. Do you know why? Because that's our design of the system. It must go up. Now, there's a balancing factor here. If they increase debt faster than GDP, which is your balancing factor, that's your income. So it's your debt racing your income. And if they grow out of whack, we see imbalances in the system, and that causes inflation. So when we look back at history, what we've seen, there's two conditions that have been present at the same time when we get these out of, we'll call it these inflationary periods. And I have a feeling that we're going to get another imbalance coming up very soon. The imbalances are debt increasing at a faster pace or money creation. So debt is money creation. History, we've seen money being created fiscally and monetarily through the banking system. In the 1970s, it was a banking system money creation process. Today, it is being driven by fiscal spending at the moment. They killed the monetary lending. They killed it here. This is the monetary bank lending that they killed, but they're basically spending massively through fiscal spend. And that's the quote, nothing stops this train. It's the fiscal problems and the debt problems that we have with interest payments. And with the interest payments being as high as they are, we can't stop the train. The money has to keep flowing into the system. Your balancing factor is your gross domestic product. Your gross domestic product is correlated with oil production, over 95% correlated, your R squared value on a linear regression analysis basis. So when you link that up, if we can't grow oil production out in the future, it's going to, and we continue to increase debt for the system to survive, you're going to get massive inflation. Massive inflation. In 1970, we had a peak oil in just America. In 2000s, it was peak oil of conventional in the world. And now what I think is coming is peak oil for everything in the world. And if we get debt continuing to go up at this vertical rate, your income cannot grow if oil does not grow. I think, and it's my opinion, that they created climate change and flow that out, basically flow that out to everybody to get renewables up to speed as fast as possible. And what they're trying to do is not scare people about, number one, any oil problems that are out there. Number two, it also makes the system more robust because you're not subjected to oil prices as much if you've got more energy supply in the system. But you'll still be subjected to it because it's the number one commodity, oil is, and it's found in almost everything. So what they're trying to do is de-link oil and GDP, which I don't think anyone has been successful in doing that yet. But that's what they're trying to do. The median age of all home buyers is now 56 years old, up from 31 in 1981. So that's the median age. Well, I think there's two things driving this. One is affordability, and two, people live longer. So if you live longer, then yeah, you're gonna. I mean, from 81, I'm sure the life expectancy isn't up very much, but um, there's a large demographic too that is older right now, the baby boomers, and that will probably also skew that number higher. So in 1981, if you've got a gigantic demographic and the average age is 31, they skew that average age lower, uh, or I should say the median age, but yeah, the average, because of the amount of people that are buying. And now they're skewing it to the upside because it's a big demographic. But I will say the millennials are a larger demographic than the baby boomers. So um, it's just more equal over time than it was before. Serious delinquencies are rising in America. If you look at mortgage delinquencies, so this is U.S. consumer stress, percent of loan balances 90 plus days delinquent is getting worse. Mortgage delinquencies are super low. Yeah, they're up a little bit, but I mean, that is a really low number. Credit cards and auto loans, I mean, that's going up. Those are the two that are seeing it. Student loans is rocketing higher from that percentage there. And I hate to say this, but these numbers on the percent change are wrong. Bloomberg. So this is what my boss would have done. This percent change is not correct because 0.53 to 7.74 on a percentage basis is not up 7.21%. It is, if you're looking at percent change, it's way higher than that. It's many multiples. My boss made a whole bunch of mistakes like that, adding and subtracting percentages. And I was like, that's not right, dude, because we had a reduction. Well, it was an increase of something. We'll call it like a productive output, which was many hundreds of percents. But he took two percentages and just subtracted it. He's like, oh, it was like a 30% increase. I'm like, no, that's not even close to being right. And I don't know how you're my boss doing simple math like this. But yeah, these are all wrong here. Bloomberg can't do math, apparently. Maybe the person who wrote the article. Logan says purchase applications data update. The winning streak continues with 17 straight weeks of year over year growth. But context is always the key here. It's plus 3% week over week and 13% year over year. Let's review. Mortgage purchase application index is up higher than 2024. But you got to keep in mind, guys, the past few years have been pretty low. So we are up 13% year over year on a pretty low number. So keep that in mind. Nick says energy bearers are relentless and the energy bulls seem tired and defeated. John Templeton used to say to buy at the point of maximum pessimism. An interesting thread to ponder. Are we at maximum pessimism yet? Well, we've got an inverted shoulder head shoulder bottoming pattern. The maximum pessimism is actually behind us if that pattern holds true. Global oil demand is resilient. Global investment has been insufficient. Net speculative positioning in near multi-decade lows, and oil prices have lagged fundamentals. Small cap and service oil and gas stocks have been down for a decade. And he goes through, talks about that huge potential upside is in his opinion. Yes, I think maximum pessimism is behind us, in my opinion. And we're riding the right-hand shoulder. And max pessimism was probably a few weeks ago. Natural gas power generation with carbon capture is cheaper than solar and storage and wind and storage per Oxford Energy. So here is the CCGT with CCS. That's your natural gas. And then you can see wind and storage and photovoltaics and storage are more expensive than carbon capture. Oh, look, stocks are up. What a shocker. And this is the U.S. money supply hit an all-time high in April for the first time in 3 years. After a brief hiatus, money printing is back. You can see this turning up. And this is going to work its way through the system, and it's going to impact commodities. it'll push or pull everything higher, however you want to look at it. Commodities versus the S&P 500. This is the most recent ratio update for the commodity index versus the S&P 500. It says a setup for the next super cycle. We're coming from a really low area. We went sideways quite a bit in the 60s, which isn't on this chart back here. And then I think we're going to rip where commodities outperform the S&P 500. Is that a year from now? Is it 6 months? Tough to say. I will say that I do see evidence of wave one up and wave two. We're trying to complete wave two before we go into wave three. What this is showing is wave three kind of ripping higher. Here is wave one coming up off the bottom. Wave one, wave two, and then eventually we'll turn and start to break across a bunch of different commodities, and especially against the S&P 500. Global flight activity and jet fuel demand are reaching new all-time highs. So number of flights continue to go up and jet fuel demand continuing to move higher, and it is above the 5-year range. Freight futures update. We've got dry bulk Capesize is up 2%, Panamax down 1%. Tankers are both down. VLCC is down 2%, and Suezmax is down 1%. We've got nuclear with the gap and go today. Who's getting involved? I'm already involved. I was involved down here in slightly above. That's where I would have been looking at potential companies. Now we've already had a pretty big move. So I would say your lowest risk reward entry point was down here in April. As we go up, your risk increases, but we are starting to break through a bunch of resistance. We could see a very big move to the upside for uranium equities. And I think that's what the case will be. Been posting that platinum will break out soon, and it is now happening. Platinum is broken out on a weekly time frame, and it is now in the making of doing it on all bigger time frames, monthly, quarterly, and yearly. The secular bull market for platinum is now resuming. Been saying since 2020 that platinum will outperform both gold and silver in this bull market, in Grady's opinion. I know we were talking about that earlier. Do not miss this historical platinum palladium bull market. Many have started to wake up to the platinum and palladium, and they say they saw it coming, which they did not. But go with us. We've played these sectors for decades, and I've been a part of and been purchasing platinum for a good chunk here, about 5 years, and a little bit longer than 5 years, in fact. I'm ready for the breakout. I'm good to go. I'm all locked and loaded. This is Felix Zulov. A lot of people like Felix. His opinions are, I think that oil is approaching a major bottom, and I expect oil 2 years down the road, in let's say 2027, I expect oil at $150 to $200. So that could be a very interesting play. I agree with that. And that's where we're going to end. We're going to end with the interesting play in oil. So that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. Use special as the coupon code if you'd like to sign up. We've got a Sunday question and answer session coming up at 5 p.m. Mountain Time. That's all I've got. We'll catch you next time. This is Finding Value.